Okay, it's 10:01. I think we're going to get started. We're giving everyone just a couple minutes to get in here. Good morning. Welcome to the very first program of our new season. I'm Margaret Mueller. I'm the president and CEO of the Executives Club of Chicago, and I'm so excited to welcome you all as we kick off with this first event of our new programming year. It's a time of new beginnings in new ways for many of us. We have a new school year, many of which is virtual. We have a new season, and for everyone who's been with us, you can tell we have a new webinar platform. So disclaimer, we might have a few glitches today. We're using this platform live for the first time. We have tested it many times, but you never know. Once you go live, some things can happen. So thank you for having fun with it, for just rolling with it with us, and thank you to Seke and Derrick for also allowing us to do this with them today. We have a lot of really exciting programs in the works, and GoToWebinar is going to allow us to provide a much more robust interactive experience than what Zoom was offering us, and you'll see a little bit of that today. So let's get into it. As a city, we have faced a trying few months as we have all wrestled with our history and the paths forward for social equality. And it's important that we, as leaders in the business community, engage in this important dialogue around fair access to capital on the journey to equitable success for all members of the Chicago business community. Here to discuss the ways that we can rethink financial equality and move to a system of unbiased loan decisions is Seke Ballard, who's the founder and CEO of Good Tree Capital, who is revolutionizing the way investments are made. And moderating today's conversation is Derrick Collins, Dean of Business at Chicago State University. If you are new to GoToWebinar, we have a few tips. So please note the slide on your screen for some guidance on how you can communicate during this program. So first and foremost, there's a small orange arrow that you see at the top of your screen that will allow you to expand the taskbar, and it will allow you to access all the communications features. Once you've opened the taskbar, you'll notice that there's a chat and questions tab where you can ask questions and submit chat messages to Seke and Derrick. A quick note that you can open and download all of the information that is on this slide in the handout section of your control panel. So if you forget about it, don't worry, go to handouts. There's a little GoToWebinar how-to, and it'll remind you on how to do things. And should you encounter any issues at all during the program, just email programs@executivesclub.org. and a member of our staff will assist you quickly. So thank you for joining us today. I want to allow plenty of time for this conversation. So without further ado, I'd like to pass things over to Derrick.
These companies bring new approaches to financial services industry. They're typically more nimble. They're less constrained by regulations. These new companies with their reliance on technology and new approaches to old problems. These companies seek to disrupt traditional players. Today, I have the pleasure of speaking with Mr. Seke Ballard, founder and CEO of Good Tree Capital. Good Tree Capital provides debt financing to companies in the cannabis industry, and it represents this new breed of financial services companies that leverage technology, custom algorithms, and new ways to make lending decisions. In addition to creating significant entrepreneurial opportunity, this new approach that Good Tree Capital promotes also have the intended consequence of better democratizing the lending process for African Americans and other marginalized groups that historically have had difficulty accessing capital, especially when it comes to raising money for their companies. So, Seke Ballard, it's a pleasure to speak with you this morning, sir.
Pleasure to be here.
Right. Let's just start off by just helping us out. Why and how did you start Good Tree Capital?
Well, let me start by providing a little bit of context on where I come from. So I'm from a small town in North Carolina called Leland, which is right across the Cape Fear River from Wilmington, which is a city that has the dubious distinction of being the only place on American soil in American history where a successful coup was staged in 1898. Wilmington was Tulsa, Oklahoma, before Tulsa, Oklahoma was Tulsa, Oklahoma. And the reason I raise that is because that is sort of in the ethos of what I care about. You know, when I think about rights and when I think about equality and people's ability to self-determine, you know, that story really rings or looms large in my background. From Leland, I went to college at UNC Chapel Hill. And I started off as a philosophy major until my dad convinced me that I might want to major in something that would lead to employment afterward. So I changed to business, and then after graduating, I joined the Peace Corps in the Republic of Georgia. And the work that I did there was really interesting. You know, I worked with local entrepreneurs, people who had shops in the bazaar, to help them find financing to be able to expand their businesses. And that work was so interesting that my goal was to really learn how to do what I did as a Peace Corps volunteer, but at much larger scale. And I thought the best path to do that would be to get my MBA. So then, you know, I headed off to Boston. I was at Harvard Business School for my MBA. And after graduating, I worked at Procter & Gamble in corporate finance for a couple of years before ultimately being recruited by Amazon to join them in Seattle. And that's where Good Tree Capital began. I was hired in 2012 to come to Seattle, and that was the same year that both Washington and Colorado had legalized for adult use purposes, so legalized cannabis for adult use purposes. So, you know, here I am, literally with a front row seat to the birth of an industry. And I love to talk about my first experience going to a pot shop. My pot shop of choice is Uncle Ike's. It's in Central District in Seattle. The first time I went, there was a massive line wrapped around the block, which was interesting just to see. And then when you get to the end of the line, which is the entrance of the dispensary, there was an armed guard. But this guard wasn't, you know, carrying, you know, a regular gun. He had what looked like to me a machine gun. I'm sure I'm calling it the wrong thing, but that to me was really jarring because this is supposed to be an experience that's no different from going into a 7-Eleven or an Exxon station, except you're showing your identification. Apart from that, it shouldn't be that different, but it was, obviously. And then when you saw the people get inside of the dispensary, they were all queued up at the ATM to get cash before going to the bud tender to choose whatever product they wanted and then hand the bud tender cash, which is then stored in a cash vault on premise. And so as a student of business, you know, as someone who's observing the birth of this industry, that entire experience made perfect sense given the legal state of the industry, where it's legalized in various states across the country, but it's still federally prohibited and scheduled as a Schedule I drug. And because of that, banks won't touch it. And so banks won't touch it. That means they don't have a place to store their cash except for on-premise, which justifies why they have this armed guard standing outside. So that to me was all really interesting, but it wasn't until the summer of 2015 when Dylan Roof went into Mother Emanuel AME in Charleston, South Carolina, and sat with the churchgoers for a couple hours during Bible study before opening fire and killing 9 innocent people in their place of worship. My mother's side of the family traced their roots to Charleston, so this hit pretty close to home for my family. And my dad thought it would be a good idea if the two of us went to Charleston and paid our respects to the victims. It's about a 10-hour round trip from Wilmington to Charleston. And so I flew out from Seattle to go to Wilmington, join my father for this road trip. And I would say that the question that animated the majority of that drive was me asking him, how did we get here? And just to give you some context of my mental state, not only were we going to pay respects to people who were killed in the house of God, but at the same time, there were a number of church burnings happening in the South. I don't know if you all recall that. And on top of that, Attorney General Holder had just lost a case at the Supreme Court, Shelby v. Holder. And one of the results of that was that you had all these southern states that used to require federal preclearance to make changes to their voting rules. They started closing down polling stations in communities full of people who look like me. And so taken together, all of this felt like what I'd read about in the history books. It didn't really feel like my coming of age. And so that's really where the question was coming from to my father. And he took some time to think about it. And his answer was and continues to be foundational for me. He said that any marginalized group of people, and let's just insert African Americans for this purpose, but any marginalized group of people cannot practically expect to sustain social and political advances unless those social and political advances are built on a firm economic footing. That's just the realpolitik of living in America. And he used his own history as a case in point. So when I was a child, my father owned a pulpwood logging company. People would pay him to clear commercial and residential property, and he would take that lumber and sell it to the local paper mill, Federal Paper. And from what I remember, this was your quintessential American small business. He employed a couple dozen people in the community. It was a healthy, growing, going concern for at least a decade and a half. And he wanted to expand. Business was going well in North Carolina, so he wanted to expand to adjacent states, South Carolina, Virginia, and Tennessee. The problem was that he had a bunch of secondhand equipment, and so he needed to modernize it in order to be able to expand his business. So he went to a number of different banks in the area, applied for loans, and he was rejected by every single bank for every single loan. And his hypothesis was that this had nothing to do with the merit of his business. Instead, it had everything to do with the color of his skin. And I was struck by this claim. Call it naivety. But there's that little equal sign that's at the bottom of every email I get from a Bank of America or whomever. And so I thought to myself, surely there must be rules on the books, laws on the books that preclude situations like this from happening. Surely my father experienced something else. And so I go back to Seattle and I do a bit of research, and I find that he's right on the money. There's fantastic research from the Federal Reserve, University of Utah, you name it. But the essential conclusion is, if I walk into a bank and a white guy walks into a bank and we have the exact same balance sheet, same assets, same debt levels, same cash flow, same credit score, literally we're the same person. The only difference is the color of our skin. Then I am 2.7 times more likely to be rejected for that loan, that small business loan. And if I'm lucky enough to get the loan, I'm going to pay on average 1.8% more in interest. And this is true across all forms of debt products: small business loans, mortgages, personal loans, car loans, and it's also true to a slightly lower degree for women. And if you think about it, in America, the two primary ways of building wealth are through homeownership and enterprise, small businesses. So if you can't get that loan to purchase the starter home so that you can start climbing your way up the real estate ladder, or if you can't get the working capital loan to expand your business, then how can you really be able to build wealth over time and across generations? And so my view was that this is a very solvable problem. And the reason it's solvable is because the root cause of the problem is the loan officer. When Sally goes into a bank, she's sitting across the table from a loan officer who's bringing to that encounter all of his or her conscious and subconscious biases. So they're not just evaluating Sally based off of what's on her application, they're also looking at her and thinking, do you fit my mold of what a successful entrepreneur looks like? And what the data shows is that Sally gets rejected even though she's qualified for that financing. My father got rejected even though he was likely qualified for the financing. And so the way you solve this problem is by removing the loan officer from the equation and replacing that loan officer with a model that is evaluating the credit risk of an applicant based exclusively on the financial and operating metrics of the business. And once you are evaluating people based exclusively on objective, observable data, then what happens, the output is that the people who are approved for financing starts to look a lot more like the richness and the diversity of the society wherever that lender is lending money. And so, I mentioned that I was employed at Amazon at the time. So I got together with some colleagues of mine, some data scientists, developers, the best in the world, in my opinion. And really, that was the question that was posed. How can we accurately evaluate credit risk while avoiding these factors that tend to bias lending decisions at traditional banks, such as gender, such as ethnicity, such as zip code even? And so the process that we went about doing that was really interesting. We started with a FOIA, a Freedom of Information Act request with the Small Business Administration. And we asked them to send us records on every single loan that they backed since the year 2000. And as you might imagine, because the SBA works with thousands and thousands of banks, this produced about 1.2 million records that we enriched with data that we found elsewhere. And then we fed that through what's called a random forest regression analysis. And what that told us was, of the over 450 factors in any given loan profile, these are the factors that are most determinant, most predictive in terms of whether someone is likely to default on a loan. And not just what those factors are, but what is their relative importance to each other. So is the number of years you've been in business, is that a 0.5 weighting, or is that a 0.0005 weighting? And once you understand the factors, the mathematical weight of the factors, you can build an equation. And that's what we did. So we built an algorithm that allows us to ingest data about the applicant and then render an assessment about the credit risk of that applicant. We tested it when we first built it and found that we accurately predicted default in 98.2% of instances. Now, the implied default rate of that is 1.8%. For comparison, the Small Business Administration, as I mentioned, they work with over 3,000 banks across the nation. So they're really, I'll call them a weighted average of banks across the nation. If you look at their trailing 10-year default rate, it's 17.6%. This is a complete 180 in terms of accuracy, in terms of ability to suss out whether someone is likely to default on a loan and do so accurately. And so at this point, I felt like we built a bazooka, and the question was, where do we aim it? We could have issued loans irrespective of industry to any small business. The challenge with that is that it's already a very crowded space. Derrick Collins, you mentioned earlier that you have a number of fintech companies that are emerging. That is very true, and those fintech companies are actively making loans to small businesses and otherwise. In addition to that, you have the traditional banks, the brick and mortar banks that have been in this industry for decades, providing services to these people. So that to me was less interesting. Cannabis, however, represented a unique opportunity that was interesting unto itself. And the reason, going back to what I had observed when I first moved to Seattle, was that because it's still federally prohibited, banks won't touch the industry. So if you look across the entire nation, of all the people who've gone through the very arduous process of securing a license from their state, I mean, all kinds of financial projections, security plans, background checks, they really go through the ringer. These people who get their licenses, 80% of those licensees do not have bank accounts. The inverse is that 20% do have bank accounts, but the fact that 80% don't means that you have a vastly underserved market of small businesses who are asking for banking services. And if you can't get an account with the bank, that means you also don't have access to debt, because banks are the chief providers of debt. So we believe that cannabis represented complete white space for us to put our model to work, to test it, to make refinements, to iterate on it over time in an industry where there's virtually no competition. And what this means is that we can make mistakes, we can learn and improve our model without some big bank coming in and eating our lunch. And so that's exactly what we did. In 2017, I raised a fund and issued our first loan in Q4 of 2017 using our technology to evaluate the risk of the applicant. And since then, we've built a portfolio of borrowers across 6 states, including the state of Illinois, which is where we're currently myopically focused. There is quite a bit of opportunity here in the state of Illinois. But I'll leave that to another question to give you a chance to get in, Derrick.
Very good. One of the things we like to do, I think, is we have a couple of poll questions that may shed some light on the issue. And so there are a couple of poll questions that are going to be provided, and like folks to participate with them. This question goes to the number of women that have received venture capital in 2019, and select from that poll. I think these questions will be instructive for us in terms of what we're talking about today, and we'll let folks to just vote on those. And I tell you what we'll do is that while the questions are being, folks responding to the questions, we'll let folks do that, and then we'll come right back to Seke. Interesting result. 2.8% of women. It was a record amount in 2019. 2.8% gives you a sense of kind of where we are in terms of venture capital access to groups within the United States. Goodtree Capital approaches the lending process in a way that's different, where you're looking at variables. You're looking at some traditional variables, I believe, that traditional banks will look at, and you're looking at new sets of data. And you're analyzing it with your own, imagine, proprietary algorithm. Without giving away the secret sauce, what are some of the kind of general factors that Goodtree Capital considers in its analysis of loan applications versus a traditional bank?
So I'll give you a sense of current state and also future state. Current state, it's actually more about what we don't look at versus what we do look at. So if you think about a traditional bank's process, typically there's a paper-based application, people complete it, they send lots of follow-up documentation into the loan officer, who then evaluates some, important operating and financial metrics with respect to the business, with respect to the individual owners of the business. And all of that is right and kosher. The problem with the traditional banking model is that not only do they consider these right and proper factors to, assess risk, there's a subjective measure to it. Jamie Dimon talked about this once. He said 75% of the loan decision is, data, and 25% of it is judgment. It boils down to the loan officer evaluating the character of the person who is applying for the loan. And my thesis is that we are terrible at evaluating character. So terrible, in fact, that it leads to these erroneous outcomes. I mentioned the SBA 17.6% default rate. That's just one data point. The data point that you polled on in terms of how much capital have women received in venture capital, 2.8% is the answer. That to me is part and parcel why we're so bad at making these sort of judgment calls. And so what we do is really isolate the decision making to what's observable. Isolate the decision to what do we know about the financial performance of the company? What do we know about the operating performance of the company? And what do we know about the owners behind the company? And use these objective measures to then make a decision about the credit risk of that applicant. And so if you look at the loans that we've issued since Q4 of 2017, and you sort of track that default rate, it closely maps what we thought it would be, which was 1.8%. And so what this tells me is when you focus the decision on what's objective, when you focus it on what's objective, you end up making more accurate decisions in terms of who should get capital. And the bonus is that those borrowers perform better than the borrowers you chose using objective and subjective. Future state, we recognize that there is a whole swath of the population that is not captured by the traditional financial sector. Perhaps they are or underbanked. Perhaps they don't engage in ways with the financial system that allows folks like TransUnion and Experian to accurately track their risk. And so we are actively looking at evaluating non-traditional data to understand a holistic picture of the risk of the applicant. A few of the things that we're looking at. How do you use utility bills as a way to understand people's ability to pay their bills on time? This is just sort of one interesting example. I don't want to give too much away in terms of the other things that we're looking at, but really the model that we're going after is, there's tons of data out there available on any business or any given individual. And our ability to source that data and house it in one place and then be able to analyze all of this data that's coming from disparate locations and being able to understand holistically what is the risk profile of this borrower. I think in both our current state and our future state, traditional existing banks are missing the mark. In the existing state, I actually believe that it's that subjectivity that's leading to these sort of less than ideal outcomes. And then future state, I don't know that they're thinking creatively about what are these other ways to fill the picture of what this borrower looks like or what this applicant looks like.
Well, given that approach, do you see Goodtree Capital as a supplement to existing sources of capital, existing traditional lenders, or is the approach more of a disruptor, or an approach that you think will displace traditional lending sources?
I am a student of Clay Christensen from Harvard Business School, and his theory around disruptive innovation is one that really stuck with me when I was a student. And my view is that traditional banking is ripe for disruption. And you don't have to look far to understand why that's the case. I just think about all of the banks. Wells Fargo, for example, paid $175 million to the Justice Department in a settlement for discriminatory lending practices. Bank of America recently settled for the same reason, discriminatory lending practices, countrywide. I mean, the list goes on and on and on. And so my view is that in a capitalistic system, if you build a model that performs superior to the existing model, then the trend lines, the futures, to me, is yours. And I believe that we're overperforming the traditional banking model in some really important ways. The most important, which is what I've focused on up to this point, has been accuracy. And that is not to be understated, because your ability to accurately determine who is going to pay you back has a direct link to the performance of your portfolio. The second major improvement is time. If there are any small businesses attending this call and you've tried to get a loan from a bank, it probably took you on the order of 3 or 4 months from the point where you first submitted an application all the way to when you got final resolution. And the reason that happens is because, again, in many cases, you're submitting a paper-based application that's being evaluated by a human, a loan officer, who then comes to some assessment, floats that assessment up to the loan committee, then comes up with another assessment that goes back to the loan officer before eventually going back to you. And so it's a very human-centric process that creates a bottleneck for decisioning the loan and analyzing the loan. And the fact that we're able to determine whether someone is rejected or provisionally approved instantly, that is a world of difference from 3 to 4 months. So that's the second major dimension where I think we're overperforming traditional banks. The third is cost. The average bank spends somewhere between 4 and 6% of principal to originate a loan. And that cost, let me just break it down where that cost is coming from. You've got banks that are heavily reliant on their network of brick and mortar branches. And that entire network of brick and mortar branches, it's full of people. It's full of tellers, it's full of loan officers, it's full of business service people. And for the most part, they're not highly utilized right now. I don't know the last time any of you have been into a bank, but I went into a Wells Fargo in Massachusetts a few months ago. I sat there for 3 hours. The reasons why are important, but I didn't see a single person come into that bank while I was sitting for 3 hours. And so when you think about that operating structure being the delivery mechanism for the services that banks provide, whether it be deposits or whether it be lending, it's very clear that it's unwieldy, it's costly, and I think it's going to buckle under its own weight. Contrary to that, it cost me less than 0.5% of principal to originate a loan. And the fact that we are able to beat traditional banks on accuracy, on timing, and on cost, to me says that this is not a supplement. This is a model that is intended to disrupt and eventually replace what currently exists. I don't believe that that's something that's going to happen in 5 years, might not even happen in 10 years, but in 15, 20 years, I don't see any reason why, I can't be the Netflix to their Blockbuster or the Amazon to their Barnes and Noble. I'm just very bullish on the opportunity and the fact that banks are just they're not operating as efficiently as they ought in the 21st century.
Well, we have our Seke. We have our first question from the audience related to evaluating startups from Christopher Lacey. With your algorithm, how do you factor in a startup business with social equity owners that don't have financial data to put into your model?
So let me carve off Illinois and just think about the rest of the nation where we issue loans. Our average borrower has been in business for 7.5 years, which I know is a big number for people to consider when you think about cannabis because it's such a new industry, but it's been medically legal in California for over 2 decades. In Washington and Colorado, that was 2012, so that was 8 years ago. So, there are some very well-established companies operating in the cannabis space. And for that reason, and we're a tiny fund, we lend to people who have operating experience for us to look at. So at a minimum, we require 6 months. And what this allows us to do is really use that data that these companies have generated over the time that they've been in operations to help us understand the risk of lending to them. So we in the past have not loaned to startups, companies that don't have operating history under their belt. In Illinois, we are taking a different tack. And the reason is because when Pritzker was running for governor, he was very clear about 2 things, at least 2 things. One was that cannabis would be a top priority. He would work to pass it as soon as he gets in office. And the second was that he wanted Illinois to be the most equity-centric market in the nation. And I thought that this represented a fantastic opportunity for us to engage the legislature on what we thought needed to be included in the legislation such that Illinois could be the most equity-centric market in the nation. And all the data points so far show that what we put into that legislation is bearing fruit. The Illinois Department of Financial and Professional Regulation issued a press release on January 2nd that said of the 700 dispensary licenses they received, 600 of them identified as social equity. That's huge. That is a massive success. If the folks who ultimately end up being licensed reflect that, that will be a huge success. The reason I raise that is because obviously none of these operators have any history in the state of Illinois. So we are lending to people who are literally just getting their licenses and will be standing businesses up for the first time. So how we evaluate their credit risk is a bit different. We rely more heavily on the individual profile and the assets available to secure the loan. In all cases, our financing is secured not only by the assets of the company, which include equipment, real estate, and always the license itself. It's also personally guaranteed by the owners of the firm. And so when you think about that securitization in Illinois, where companies don't have the operating history for us to plug into, it changes how we're able to evaluate the risk of that applicant. But given how the legislation is structured, we believe it's a good risk. It's a good bet to take on for these folks who don't yet have operating history.
As an old lender myself, it's interesting to hear that although we get away from and look at different ways to analyze lending, and there's certain things that you still try to keep common. So the personal guarantee is one of those things. Also, I have a few more questions for you, but I also wanted to encourage the audience members to submit questions as we talk. So let me just go back a little bit. One of the things is the theme here is that you start a Good Tree Capital is really to kind of help bring better and broader access to capital, especially for African Americans and other marginalized groups. And historically, it was always thought, or some people thought that Black-owned banks would do that. But over time, one of the things that we found out over the years is that many of the banks, by definition, had riskier portfolios because the people they were lending to were at greater risk and on the margins of society. So the old saying that we would have in the Black community that when white America catches the cold, we catch a flu, right? So when the markets start to tremble a little bit, you see a lot of mass failure. So given that historical backdrop, does the diversity of Good Tree Capital's portfolio provide some measure of risk reduction or not shielding from risk, but kind of reduces the risk, given you have a wide swath of players in that cannabis industry, more diverse portfolio?
100%. And that's an interesting point that you raised. There was a really great article in the Atlantic back in 2016, I think, and the topic of the article was Black banking. And in the article, they talked about why Black banks were needed to begin with, over 100 years ago. And the reason is not too dissimilar from the reason today. If you were an attorney, if you were someone looking to start a law firm, someone's looking to start a bakery, someone looking to start a barbershop, you couldn't get financing from majority-owned banks to be able to do that. So it represented really an existential problem in terms of being able to develop economically. And so you had a number of enterprising Black people back then to say, well, why don't we create our own banks? And they did that. And at the height, there were 100 Black-owned banks in America. But you mentioned this when, this is an old adage that I heard growing up when, white people catch the cold, Black people catch the flu. That's exactly what happened during the Great Recession. So when you had this wave of bank failures happening during the Great Recession, the rate of failures was even higher for Black-owned banks. And the reason the failure rate was higher for Black-owned banks was because their portfolios were heavily, if not entirely, concentrated in Black communities. And to me, what this means is, you know, when the Black community catches the flu, when they're laid off, when their companies fail, when, you know, mortgage values take a hit, your portfolio is going to reflect that. The only way to really manage that risk is by being diversified. And so, you know, the challenge that, you know, I think we're up against, one of the challenges that we're up against is that, you know, while at the height there were 100 Black-owned banks, today there are just over 20 Black-owned banks. So the problem that they were originally started to solve still exists in more diffuse ways, but it still exists. But the capacity to be able to solve that problem has greatly diminished over time. And I think that the chief reason is because of the health of the portfolios of those banks. And so when I think about the path forward, we have to have a mindset of how do we create access for everyone who's qualified. Because when you create access for everyone who's qualified, the women who are qualified, the immigrants who are qualified, the poor white people who are qualified, the Black people who are qualified, the Latinos who are qualified, when you create a model that's looking at everyone objectively using the same measuring stick, what happens is your portfolio starts to reflect that diversity. So in the case of Good Tree Capital, we lend throughout the value chain, the supply chain for cannabis. So whether you're a cultivator, a dispensary, everything in between. We also lend to ancillary companies that support the industry but don't touch the plant. And we do this in various different states. So all three of these create really good diversification for the portfolio, which, if you know, going back to the 1.8% default rate that I referenced, it sort of helps you understand why that default rate is as low as it is. And so, you know, really one of my biggest fears in the future is that the capacity for minority-owned banks to address these problems in the future has gone down, but we haven't figured out an alternative to stand in the stead of those 100 Black-owned banks that existed in the 20th century. So, you know, really, I take it as a part of what we're doing is to be one of those alternatives. You know, to be that 21st century answer to how do we create equitable access to capital in a way that is digitally native and is suited to how people engage with financial services today.
Great, thank you. We're gonna let you take a sip of water while we have a second question, poll question for the audience that kind of gets to this issue of broad access to capital. Black founders receive what percentage of VC funding? The 3%, 2%, or 1% of venture capital funding? This goes to quite a bit of your thoughts around access to capital and the democratization that Good Tree is bringing, but also understanding where we are is a great place for us to begin this conversation. So we'll see what the poll results are. 71%, 1%, which is absolutely right.
It's a smart audience. They keep getting these answers right.
Absolutely. Smart folks watching this. So just a quick question. The Good Tree Capital right now, do you plan to remain focused on the cannabis industry, or do you see being able to take your approach in expanding this type of financing or this approach to financing onto other industries?
I have always viewed cannabis as a tactic, not the strategy. It is a path of least resistance. I mentioned earlier that in this industry, because banks aren't participating, it's all white space, so we don't have a ton of competition here. And so to me, what that means is we can use cannabis as an industry to gain scale, to see how the model works, to perfect the model before eventually expanding that model to cover adjacent industries and other industries. So the long-term view is for us to absolutely provide financial services to a broad set of small businesses. And really the way we do that is by focusing on the technology. So the way we're structured is that, you know, there's the holding company that owns the technology that houses the developers and the data scientists who work on the technology, and we license that technology to Good Tree Capital to be able to make loans to cannabis companies. My goal is to license this technology to other banks, other financial service providers in the future, because my view is once they have the ability to understand the risk profile of their borrowers instantly, at the cost that we're able to determine it and at the robustness and accuracy that we're able to determine it, I think they will see the value in that and eventually choose to use it themselves. Perhaps it supplants their existing process, or perhaps they use it just as a supplement to their existing process. But I think the way that we issue loans definitely has traction outside of cannabis. I think it's really the only way that I can really make a meaningful dent on the problem that my father initially articulated. If I'm only lending money to cannabis companies, that's good, but I don't think it really sort of addresses the issue of broad-based economic development, fair access to capital, whether you are a bodega, whether you are an established accounting firm. So long as you're qualified, really, you should have access to that capital to be able to grow your business.
That's a very interesting approach, that if going forward, you can see yourself sharing some portion of your approach or your algorithm with other folks to approach lending in this manner or a similar manner. If you fast forward a few years and you see other players come into business, they're using these types of similar approaches where you're bringing in data, looking at which right now is kind of non-traditional metrics, but will maybe be traditional metrics by then. Looking at it that way and doing this kind of analysis, when those players come in, how do you differentiate yourself? How do you then separate yourself from other competitors if now folks have kind of leveled the playing field with similar proprietary algorithms that kind of drive down the default rates and you have better lending decisions? Now, how do you compete?
So the biggest challenge one of the biggest challenges in banking right now is they cannot figure out how to profitably make loans to businesses that are applying for loans under, call it $250,000. And so you've had a number of national banks, and I'm thinking JP Morgan as a sort of case in point, that have invested in being able to automate their ability to issue loans, these small dollar loans to businesses like that. So they forged a partnership with a company called OnDeck years ago. I think they've since split. But OnDeck is in the same vein as Good Tree Capital, except significantly larger, is in the same vein as Lending Club. These are companies that are really focused on using and leveraging technology to make lending decisions quickly. And so you see that activity happening at the big bank level. The problem is that you don't see it penetrate deeper than the national banks. So when you're thinking about the regional banks, the local banks that are quite frankly the majority of the banks in the nation, they don't have the financial or the technical expertise to be able to go down that path. And so, one of the things that I hope happens in the future is that you have these enterprising fintech companies that are creating models, different new models for how you issue loans, hopefully models that are inclusive and rooting out factors that create bias, that these regional and local banks ultimately start plugging into. I don't think it's a question of if, I think it's a question of when. Every single bank is going to be forced to change how they issue loans. One option might be to plug into how we're doing it. Another option might be to build it in-house. And another option might be to just buy it. But I think it's a decision that every bank is going to have to reconcile at some point.
Okay, great. Now I just asked you a question about competitive advantage in the future as things start to change. We have a question from the audience from Tom Contos that gets to current competition. Tom asks,
I'm sorry? I know,
Okay,
Tom.
okay. Well, he asked you, outside of your proprietary algorithm, what would you say your competitive advantages are relative to other low-cost fintech companies?
Well, I think our focus on objective credit risk analysis is a very strong competitive advantage. No other company is doing it. Big banks, little banks, fintech companies, no one else has that perspective. And just to sort of underline how important this perspective still is, I'll use Apple as a case in point. They are currently under investigation in the state of New York for charging women higher interest rates and approving them for lower credit limits than equally qualified men. So this is Apple. This is one of the most technologically sophisticated companies in the world, and they've not figured out how to issue credit limits and interest rates in a way that is fair. And so my view is that more now than ever, I think Americans are looking for a different approach. And I think they're looking for a different approach that corrects for historical imbalance. I think they're looking for a different approach that is inclusive of everyone who is an American citizen. And so to the extent that this is our ethos, this is our mission, this is what drives how we build our technology, I think that creates distinction for us. But to be completely honest, I don't know that you need a whole lot of distinction because it's so big. This is many trillions of dollars that banks are issuing in loans. And currently, 65% of that is held by brick and mortar traditional banks. So you can be an average run-of-the-mill fintech company that's decent at what they do and still be able to gain some market share. That's my view. And so that's me being a little cynical, but I think not only is our focus important for our long-term longevity, I think the three factors that I mentioned earlier around accuracy, around cost, and around speed are also enduring competitive advantages, not just against traditional brick and mortar, but also against the fintech players. But really, my targets are on traditional banks. I'm not really thinking about the fintech companies.
Okay, great. All right, another question from the audience. Here's from Marjorie Robinson. What are some pitfalls, if any, of government loans earmarked for cannabis startups in Illinois, like DCO, WBDC, et cetera?
Right. Well, this was, when we were advocating with state legislature to, craft the bill, we had two goals in mind. The first goal is that we wanted to lower the cost to the furthest extent possible to social equity applicants applying for licenses. And the second goal was to increase the state's support, financial support of that same group of people. So on the first goal, the success that we had was removing real estate as a requirement in the application. So typically, in any other state, if you want to apply for a license to operate a cannabis business, you have to either lease or purchase the real estate before you apply. And so that means you've got money going out for this real estate for sometimes 12 to 18 months before you learn whether it's yay or nay on the license. And if it's nay, then really, you're kind of out of luck. And so they removed real estate as a requirement, but they require it once you've been provisionally licensed. On the other side of it, which was increasing the state support, we proposed two possibilities. One was to create a state guarantee for investors who provide loans to social equity cannabis operators. And really the thought was very similar to how the SBA backs loans via banks. So if the state is able to back a certain percentage of the loan, that will encourage investors to come in because the risk profile changes if the state is supporting them, to then invest in these companies. The second idea that I proposed was the state creates a state-funded fund. that's used to make low interest loans to social equity applicants. The legislators ultimately ended up landing on the state created fund, and today it's a $30 million fund that was created to make low interest loans to social equity applicants to stand their businesses up. What I've heard from social equity applicants who have engaged with the Department of Commerce with respect to this fund, it hasn't been great. What I've heard is that they're not super responsive, and the amount of paperwork and requirements to access the loan is, really kind of tremendous. So, that's really a long answer to your question, but really to sort of wrap it all up, I think the biggest challenge with getting financing from the state is going to be around the strings attached to that financing. So currently, if you get a loan from the DCEO, you're not able to spend that capital on some pretty important line items for, an operator that's just coming up. But if you're able to get the financing from them, I don't think it's bad to get the financing. I just think it's onerous to get to the point where you're approved. And then once you're approved, there's a lot of strings attached to how you can use the funds. But when you take a step back and you think about the costs required to stand the cannabis business up, it's pricey. And the DCEO is only a small part of that equation. So my suggestion is to use financing from the DCEO to accomplish what's allowed within the framework of what they permit. And then you have to seek out financing from other sources that have fewer strings attached, that allow you to purchase things like inventory, for example, or working capital to be able to start hiring and training employees before the store opens.
Thank you. Well, Seke, we have about 2 minutes left before we release these executives to go back to their work. And we have one final question for you. And you clearly see GoodTree Capital as more than just a money lender, but as a potential tool for economic prosperity. Given this, what is your long-term vision and potential societal impact for GoodTree Capital? Thinking long-term, what do you see and feel that could happen with GoodTree Capital?
Yeah, well, I'll take you back to my childhood. My first job at the age of 16 was as a waiter at the Waffle House in Leland, North Carolina. And I would work Fridays and Saturdays, and I would take my tips and I would deposit my tips at my account at Wachovia, which is a bank that has ceased to exist. And on this particular day, in my memory, I went out to buy some school supplies, book bags, papers, pens, all that jazz. And after buying the school supplies, I learned that I'd racked up about $150 in overdraft fees for supplies that probably cost about $20. And so I called the bank, Wachovia, and I tried to explain to them, hey, I have the money, it just wasn't in the account. Can you remove these overdraft fees? And it was like talking to a brick wall. They're like, no, these are the overdraft fees, it's the policies. You didn't have the money, therefore you need to pay these overdraft fees. So I ended up paying about $170 for $20 of products. Wachovia was eventually acquired by Wells Fargo during the Great Recession. Health of their portfolio was pretty bad, they had to be acquired. Wells Fargo, in my view, is a bank that is full of criminals. They are creating accounts that their account holders didn't ask for. They are charging them fees for services that they're not using. And they've gotten in trouble with the Justice Department multiple times because of this kind of behavior. Long story is that I believe that banking is rotten at its core. And I know that's a hard message for some people to hear, but I believe it's rotten at its core. And when I think about my long-term future, it's a very grandiose vision for myself in the future. I see success as running Wells Fargo out of business. That's what success looks like to me. When the traditional model has become so untenable, when alternative models have proven themselves to be more successful, that these sort of dinosaurs really just sort of die under their weight. And so when I think about the long-term vision of Good Tree Capital, I think of us as being a digitally native financial service provider, where we are enabling not only deposits, but also loans to qualified businesses, qualified individuals, and hopefully creating, a meaningful impact on the problem that I initially sought to solve.
Great. Seke Ballard, founder and CEO of Good Tree Capital. Thank you very much, sir. You've enlightened us quite a bit. I know there's a number of financiers out there that are probably going to go back and try to prepare for your coming in terms of competition. So I want to thank the audience. Yeah. So I want to thank the audience for participating. Thank you for your questions, and also want to thank the Executives Club for providing this forum for us to have our discussion today. You guys have a great day today. Take care.
Thank you.
All right.